Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Chris Vermeulen from the TechnicalTraders.com. Welcome back to the show, Chris.
Hey, thanks for having me, Jim.
Nobody can ignore the story of crude oil because you're reminded of the high prices every time you go to fuel up your car, unless it's electric, and most of us are not privileged enough yet to have electric cars. What do you think is going to happen with crude oil?
Yeah, it's a tough call. I have a feeling crude oil is still going to be going higher. I think we could see this continue to stabilize. I mean, we've seen a pretty strong pullback in the last couple of trading sessions. I think we've seen oil pull back roughly 28% in the last week. Down from its, 135 per barrel level. I think we're going to continue to see crude oil hold up around these levels, around the $100 plus mark, and maybe take another run, another push back up and see if it can hit those highs that we hit back, in 2008, 2009, or 2008 there, where we saw, get up to almost, $150 per barrel. So I think we're going to continue to see high commodity prices. I mean, this really is the perfect storm for higher commodity prices with war and the supply chain issue. The world just can't catch up with what they're behind for producing products and farming and all that stuff. So there's so much demand, and it's hard to get it because of shipping problems. And I think we're in for high oil prices for a while, and they could still go higher. But I do think from here on in, it's going to be a little more steady. I think we're not going to see a parabolic spike. I think we're actually just going to see it stabilize and then continue to kind of drift higher for a few more months.
China, of course, we've heard about new lockdowns there, and that means reduced demand. When you shut down a city of 10 or 12 million people, that's a lot of oil demand. Plus, none of the products are being shipped out. That means truck and rail and ships are just sitting there empty. Do you see any cure for this supply chain problem where, again, the world's economy is so intertwined that if one port in China shuts down, all of a sudden somebody in England can't get a garden gnome?
Yeah, I mean, China's definitely a huge player. As much as America is kind of like the heartbeat of the world. I mean, really, without China, there's nothing, because most stuff comes from China, and they're such huge users of energies, of supplying products to pretty much every country. So it's a big issue. I mean, we've seen the Chinese stock market take a huge hit, especially in the technology side. In the last 2 days alone, we've seen the Chinese large cap stocks in almost one day, they rallied 25%, the large cap stocks. And that's kind of like a grouped index of the large caps. Some of these individual tech stocks were up 50, 100% in one day. So we're definitely hitting some kind of extreme level in terms of some panic selling in the stock market. I think we're at short-term lows, but I do think we're going to see a lot more pain when it comes to stocks and commodity prices, meaning higher commodity prices and lower stock prices as we try and work through kind of the chaos of what's going on, rising rates and war and high energy costs, inflation. There's just so many things going at play here that there is no clear direction, but definitely it still has a very negative bias for the economy and for stock prices.
Copper, is it going to continue to be one of the hottest commodities?
The copper miners have done exceptionally well when you look at there's a copper miner ETF called COPX, COPX. And I mean, it's been a leading sector, doing really well. It's got a very strong chart pattern. It's showing that copper miners look like they're primed and ready to have another big rally. And when you look at the price of copper itself, I mean, it's been moving up, broke that $5 level a few weeks ago. I think we're going to continue to see a lot of metals across the board, a lot of commodities in general, I think, actually keep moving higher. Copper is up again strong today. Really, when you look at the whole commodity complex, almost all the commodities have sold off pretty sharply in the last week and a half, 2 weeks. And that was because pretty much the commodity space became a crowded trade. It became mainstream media. Everyone talked about it. All kinds of people who really don't know much about the markets are all saying that they're getting into commodity stocks, they're getting into commodities in general, and that created that big surge. And right now, we're just seeing commodities kind of take the wind out of the sails a little bit, pull back, kind of shake those traders or people who moved in. But I think we're going to see commodities continue to move up. I think building materials like copper, wood, like lumber are going to continue to move higher. And, the commodity space got a little overbought. I think it's going to stabilize, just like crude and pretty much everything else in the commodity space. Trade sideways for a few weeks, maybe even a couple of months. But then I think we're going to see another push to new multi-month highs or all-time highs for a lot of commodities, including copper.
We'll have more with Chris Vermeulen right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Chris Vermeulen. Chris, one Chinese tycoon gets into trouble with a $6 to $8 billion short on nickel. They shut down the London Metal Exchange, and then they come back online. What did that do to prices?
Yeah, the whole nickel, there's an ETF that allows you to kind of track the nickel commodity, and it's JJN. It just did a huge spike. I mean, we saw it within a 5-day window. We saw the ETF rally 134% to the upside. It pretty much went straight up, and then it has come straight back down to where pretty much it left off, before the spike happened. But we've got this crazy volatility. We're seeing all kinds of weird things happen in this market that add a lot of risk. We're seeing commodities like that spike and take off. People are talking about potential big short squeezes in gold or silver. We're even seeing really funky stuff with the VIX ETFs. One of the VIX ETFs rallied like 45% 2 days ago. And the VIX didn't do anything. The VIX itself moved like 1.5% that day. And there's just a lot of things going on when an ETF stops providing liquidity, prices spike. We're really into some high volatility, very chaotic times. And I think a lot of people, the reality is most people see this volatility and they're like lured in like a bug zapper light. And as soon as they see this volatility, they think they need to get in here and get aggressive and start doing trades. Really, it's like the worst thing you could do. You're walking through a landmine. This is a news-driven market. You could, you get into this nickel play. I mean, if you're on the wrong side of it, you just, lost all your money and then some. And same with the VIX play. If you're on the wrong side of the VIX, this was a 1-day blip because the VIX and the issuer are having issues. I mean, it's a real problem. The volatility and the lack of liquidity and things being cut off from war, from financing, from all these different reasons, I guess the whole point here I'm trying to say is it's just really dangerous, and people are looking at this like it's a great opportunity, but it's only a great opportunity for those who are really honed in, really know how to trade and are focused on short term, and they don't just, jump into these trades and think they're going to last a long time, because most of these opportunities are short-lived. You got to get in, make your money, get out, and then go look for some fresh opportunity.
Now, there's a television ad. I think it's almost criminal. It's TD Trading. It features a young guy, obviously in his 20s. I don't know nothing about investing. It looks so hard. And he has these nightmares about having to go to Harvard and all these papers and charts and graphs. And then his kind friend says, oh no, look, you can just get an app on your phone and TD will even give you the money to trade. It's really easy. It's like a video game. What's going to happen to a person who is like that? Here's 10 grand. Let's see what you can do with it right now in this kind of market.
It's terrible. I mean, all they're really doing, and this is where Robinhood got into trouble. Robinhood did the same type of thing. They make it so easy and so amazing and easy to trade. And you get the app and you hit a button and there's no commissions, yet they have other ways of making money off you. When you hit the buy, you get a really crappy fill because they're profiting off the spread, the difference. Anyway, it's a huge problem because people think that you can trade and make money off your phone, and it doesn't really work that way. Sure, you might make some trades and they work through your phone, but the reality is a real trader is following the charts. They're not on their phone trying to, look at multiple time frames and seeing how everything's going on. You might manage some odd positions, take profits, get out of a trade on your phone because you're on the fly somewhere. But those really easy apps, so like just buy this, you click here, it's super easy. It is the perfect storm for everyone who has that mindset thinking it's going to work. They're going to lose money, and that's what happened in 2020 with the big bubble. We saw everybody pile in to stocks, and same with 2021. Most people lost their shirts. 2021 was a very hard year on individual stocks and sectors. The indexes went up, but stocks just did not perform well in general at all. And it's a disservice. It's too bad because so many people are excited to get into the stock market, and I get it. It's the ultimate opportunity. It's the ultimate casino. You can be the house. If you know what you're doing, you can win a lot more trades than you lose. But the problem is these companies come out and they make it look so easy and so simple that it gives false realities. It doesn't give them the right, proper expectations of how the markets work and how you need to manage positions. And people they go in, they lose a bunch of money, and then they hate the stock market and they don't want anything to do with it. I mean, we've seen record outflows of brokers stating quarter after quarter, a lot of them are losing like 20 or 30% or more of their clients in the past year. Each quarter, just people give up, they can't make money, and the reality is the markets are very difficult to make money. And if you say it's easy and you give them an app that's push a button, go buy your favorite stock that's on the news today, I mean, you might as well just be giving money. You'd be better to go donate money to charity. At least it's going to a good cause.
Well, they claim when you go to a government-run casino, it's going to a good cause too. So you might as well just put 10 grand on red on the roulette wheel and either double it or lose it all.
Yeah, it's pretty much it. I mean, that's it. You either lose it or win a bunch right away, or you can gamble it and be a slow bleed out, right? Casinos in general will take your money over time. So, and that's how the stock market is. If you're not vigilant with waiting for perfect trade setups and managing those positions, you're going to lose money in the long run. And a lot of people, unfortunately, make a bunch of money on a couple really high-risk trades that they didn't know were as high risk as they were. They get in, they make a fortune, and they think they got it figured out. And then over the next 2 years, 5 years, 10 years, their account never grows. Generally, it goes sideways or loses value. And they waste so much of their life trying to trade with these false beliefs that money should be made quickly, you need to trade a lot, you gotta trade aggressively. I mean, they all see the markets the wrong way, unfortunately. But that's what makes a market. I mean, the more novice traders there are, they create these big sentiment swings. It's great opportunities for those who know how to profit from the herd mentality. And without the herd, it's not easy for technical traders to make money. So, you always have to have one side of the coin so that there's the other side.
Chris, what do you tell your clients who are concerned?
Well, the key here is, depending on what they're concerned about, everybody's got their own reasons and their own time horizons of what they're looking for. But the reality is, if you use technical analysis, which is what we do, we follow price. I can say, it looks like gold's going to go to 2,600, but until we have a new buy signal, the charts confirm it, and we've got, something solid to go on, we don't do anything. We sit in cash, we wait for the opportunity, and then we're going to get in. And so the key here is to try not to worry about being in trades all the time. Don't think that just because the stock market rallied in the last 2.5 days, that you should have been in there and caught these trades. Unfortunately, people see a big one-day move and they think they should have got part of it. But that's not the way trading works. You have to step back and be patient. Look at your trading like as a yearly kind of view. Review it yearly. How did your account grow? And just every year the market's going to be in a bit different stage. Different strategies are going to work better during different years. And you have to look at it that way. But so many people get caught up with the short term. They think every month there should be gains or every quarter. And that's not the reality. You go look at any hedge funds and money managers, if the market goes up, they make some money. If the market goes down, they lose money. And year over year, it's usually pretty nominal. It's going up and down. Yet people think they should be making 10% or 25% return a month on their money. And if you're trying to do that, you're going to blow your account up. You're not actually like managing risk. You're really pushing a lot of money into highly volatile trades and trying to, really push things where they shouldn't be pushed. So the key is to try not to get caught up in that and be more patient and look at investing and trading as kind of this year, what is the whole year going to involve in terms of the trading style and how often to trade it.
Chris, thank you so much for chatting with us.
Hey, thanks for having me on the show, Jim.
My guest has been Chris Vermeulen from thetechnicaltraders.com. If you have any questions for Chris or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.